Hey everyone, welcome back to Corporate Decoder, the place where we break down company filings, and let me tell you, AutoNation's latest report is serving up some serious numbers that are definitely worth decoding, especially when it comes to their car inventory and how they're financing it all. Before we dive in, if you appreciate getting straight insights from corporate documents like this, make sure you're subscribed. We also have a Discord community linked in the description below where we discuss all sorts of financial news and deep dives. Alright, let's jump right into the heart of the matter, the financials. Looking at their balance sheet as of the 30th of September 2025, a few things jump out. Their inventory number is pretty massive at over $3.4 billion. That's a lot of cars sitting on the lot. Now, a big chunk of how they pay for that inventory and other operations is through what they call vehicle floor plan payable. That's essentially short-term debt used to buy cars. It's split into two main parts, trade and non-trade. The trade portion, which is tied directly to manufacturers, is a bit over $2.1 billion. The non-trade portion, which covers other lenders and used car financing, is even higher at $1.6 billion. That's a total of almost $3.8 billion in just floor plan debt. When you stack that against their cash on hand, which is under $100 million, you can see just how much they rely on this financing to keep the choppers turning. Now, let's talk about the money they're owed from customers financing cars. Their auto loans receivable sits at just under $2 billion. It's important to note they've set aside about $89 million as an allowance for credit losses. This means they expect a portion of these loans to go bad, which is pretty standard for a finance operation. But when you look at how much this number has grown from just over $1 billion at the end of 2024, you can see they're actively originating and holding more loans. This growth fuels their AutoNation finance segment, which we'll get to, but also ties up a lot of capital and increases their risk if the economy takes a downturn. Looking at their overall liabilities, the total current liabilities are a staggering $5.9 billion, and that does not even include their long-term debt, which is another $3.1 billion. This is a huge amount they owe, and while the company has significant assets, it's crucial to understand how they manage this debt load. Now let's shift gears to their income statement. For the third quarter of 2025, the company reported total revenue of $7 billion. That's a solid increase from the $6.5 billion in the same period last year. For the 9 months of 2025, their revenue reached over $20 billion, showing consistent growth. New vehicle sales are their biggest revenue driver, bringing in over $3.4 billion just in the third quarter. But here is where it gets interesting. While revenue is up, their gross profit for new vehicles actually dropped by 15% compared to the previous year. This means they are selling more cars but making less money on each one. The report mentions higher vehicle costs, a shift towards more hybrid and electric vehicles, which naturally have lower profit margins, and that margins are moderating from the super high levels seen post-pandemic. Coupled with new tariffs announced this year on imported vehicles, this is definitely a segment to watch. On the flip side, their parts and service revenue, which only makes up about 17% of their total revenue, is a real profit powerhouse. It contributes nearly 47% of their gross profit. For the third quarter, they saw a 7% increase in parts and service gross profit. This area is incredibly important because it typically has much higher profit margins than selling new cars and is less affected by the ups and downs of new vehicle supply and demand. And then Therese finance and insurance. This segment, while only about 5% of revenue, brings in a massive 29% of their gross profit. Their finance and insurance gross profit jumped 12% in the third quarter. That's driven by higher margins on things like vehicle service contracts and simply selling more vehicles overall. When you look at the pie chart of gross profit mix, you can clearly see how vital these two segments, parts and service, and finance and insurance, are for their overall profitability. A significant development here is the goodwill impairment charge of over $65 million recorded in the second quarter of 2025. This isn't a cash outflow, but reflects that a part of their business, specifically their mobile service operation, is worth less than they originally thought. This happened because their updated projections for this business showed lower future cash flows. They also took a $71 million hit for franchise rights impairment. This means the value they placed on some of their dealership franchises has decreased, likely due to underperformance or future outlook concerns for those specific locations. These are non-cash charges, but they do impact their net income significantly. Remember that auto loan receivable number we saw earlier? That's the backbone of their AutoNation finance segment. For the third quarter, this segment actually turned a profit of $1.5 million, a big improvement from a loss of $6.2 million last year. This is thanks to growth in their average managed receivables, meaning they're originating and holding more loans. They also saw a decrease in their provision for credit losses, meaning they expect fewer loans to go bad, which is a good sign for their loan portfolio quality. This segment is clearly a strategic focus for them, aiming to capture more of the financing income that was previously going to outside lenders. Now, let's glance at the cash flow statement. It shows that for the 9 months of 2025, their operating activities actually used cash, a negative $38.6 million. This is largely due to a big increase in the auto loans they originated. Their investing activities also consumed a lot of cash, over $529 million, mainly due to acquisitions and purchases of property and equipment. On the financing side, they brought in over $590 million. This was driven by substantial non-recourse debt borrowings, which are used to fund their auto loans, and the issuance of new senior notes. They also continued to buy back their own stock, spending over $434 million on repurchases. Looking at the same store numbers, which strip out the impact of new acquisitions or sales of stores, we see that for new vehicles, same store revenue went up 7.3%, but again, gross profit per new vehicle dropped by almost 19%. This is a clear trend showing they're selling more cars, but the profitability per car is shrinking. For used vehicles, same store revenue grew about 6.6%. However, gross profit per used vehicle actually declined by about 6%, so even though they moved more cars, they made less profit on each one. It seems the cost of acquiring used cars is pushing down those profit margins. The parts and service segment, however, continues to shine. Same-store revenue here increased by nearly 6%, and more importantly, gross profit increased by 7%. This segment remains their profit driver, proving that after-sales service is a fantastic business to be in for an auto retailer. And finally, finance and insurance, where same-store revenue and gross profit saw a nice increase of over 10%. This boost is attributed to higher margins on things like service contracts and simply selling more vehicles overall. Digging into their segment results, the domestic segment continues to be a strong performer. Revenue is up by over 9%, driven by a significant increase in new vehicle unit sales. Their segment income also grew by an impressive 30%. This is partly due to an increase in finance and insurance profits and also better cost management. The import segment also saw revenue growth of over 6%, again led by new vehicle sales. Their segment income saw a healthy 7.6% increase, driven by strong performance in parts and service and finance and insurance. The premium luxury segment showed solid revenue growth of over 5%. While new vehicle gross profit per car decreased, the segment income still managed to go up by a respectable 4%. Strong performance in finance and insurance and a slight dip in costs helped boost profitability here. The AutoNation finance segment, as we mentioned, moved from a loss to a near break, even profit for the 9-month period. This is a key strategic win, showing their ability to generate financing income and manage credit risk as their portfolio grows. Now, looking at expenses, their selling general and administrative costs, or SG&A, went up by almost 5% in the third quarter compared to last year. A big part of this increase is in compensation, likely due to higher sales volumes and performance-based bonuses. They also cite acquisitions, related expenses, and newly opened stores as contributing factors. However, as a percentage of their total gross profit, these costs remained flat, which is decent cost control. A major financial factor for auto dealers is floor plan interest. With interest rates still relatively high compared to a few years ago, this cost can add up. For the third quarter, their floor plan interest expense decreased slightly compared to last year, which is good news, and likely due to a combination of lower average interest rates and a slight reduction in their average vehicle floor plan balances. Now, let's talk about their debt. As of the 30th of September 2025, their leverage ratio was 2.35 times, well within their allowed limit of 3.75 times. Their interest coverage ratio was also strong at 4.79 times, comfortably above the required 3.00 times. This indicates they are managing their debt effectively and have a good cushion to handle their interest payments. So, what's the overall story here? AutoNation is navigating a challenging market with increasing vehicle costs and moderating profit margins on new cars. They are successfully growing their higher margin parts and service and finance and insurance businesses, which is a smart strategy. Their finance arm is showing promise, expanding its loan portfolio and proving profitable. However, the significant goodwill and franchise rights impairments signal that some parts of their business are not performing as expected. Their debt levels are substantial, but they seem to be managing them well for now. The ongoing impact of tariffs and potential economic slowdowns remain key risks to watch. That's our deep dive into AutoNation's latest financial report. What are your thoughts on their strategy and these numbers? Let us know in the comments below. If this breakdown was helpful, please hit that like button and subscribe for more. And don't forget to join our Discord community for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.